Welcome to this episode of Hampton Roads Business Live. My name is Rory Graham, and I'm your host. And today we have the pleasure of having with us Jim Cadle from Guaranteed Retirement Solutions in Virginia Beach. Welcome.
Thank you, Rory. I'm glad to be here.
Nice to have you. Give us an overview of what is Guaranteed Retirement Solutions.
Well, the name says it all.
Yeah, I was going to say, well, that's kind of a dumb question, but go ahead.
Well, a little background on that.
Okay.
I got licensed in Virginia back in 1988 with Virginia Department of Insurance, Life and Health. And back then I was usually working with the older people, Generation 2, World War II generation. Tom Brokaw called them the greatest generation. And mostly what they were interested in was avoiding probate on their estates, saving taxes, and get a little bit more interest than they were getting from their CDs. Well, you know, most of those people are gone. My daddy and mother are gone. So a lot of them are not with us anymore. And now I'm working mostly with baby boomers. And there's been a lot of surveys about baby boomers and what their interests are and how they act. And I'm one of the baby boomers, by the way. Mm-hmm. And they asked them what their greatest fear was. And the greatest fear for baby boomers was not dying. It was running out of money during retirement. That's their greatest fear, which is kind of a thing that's happening right now to a lot of people because of the way things have changed since our parents were around. So my goal is to help out these people to have a safe, secure, and happy retirement. And that's what we do at Guaranteed Retirement Solutions.
That's a big goal.
Well, it is. And we're pretty successful at it, too.
Okay. Now, you told me that you have three legs to a retirement stool.
Right.
You want to explain that a little bit?
Yeah, right. The proverbial retirement stool. That's what
Right.
people talk about. You got the stool that you sit on in retirement, and it's got three legs.
Mm-hmm.
One leg is pensions, another leg is Social Security, and the third leg is savings.
Okay.
So you need,
well, the pensions are about gone now.
that's exactly
pretty much, right?
Yeah, and the reason they are is because these companies, you know, you work for them for 30, 40 years and you retire with a proverbial gold watch and then you get this pension for life. Well, they got too expensive. It's called defined benefit plan. And so the corporations couldn't afford them anymore because people are living longer. And so what they did is they changed to defined contribution plan. Defined contribution plan is 401k. So what they did is they shifted the risk of retirement from the company to the employee. So they have to provide for their own retirement now with the employers adding some to their match on the 401k. They'll do 1, 2, or 3% usually. And you should always go to your match on the 401k. So that's free money. You should take that. Mm-hmm. But the problem with 401ks is when you retire with a 401k, how long is it going to last? Because with the way the market's been the last 14 years, it's been up and down. If you retired anywhere in the last decade, chances are you'd run out of money. Now, the people that are supposed to be smart about figuring out how much you can take from your account, they say you should take 4%, you should be okay. Well, that's not always true. Because many times, if you last long enough, you run out of money before you run out of breath. Mm-hmm. So that's not a good scenario now. So the 401ks replace the pensions. Social Security, well, we know there have been changes in Social Security. And the younger generation thinks that there's going to be a Martian landing on the Earth rather than getting Social Security. That's how they feel about Social Security. It's not going to be there for them. Well, I doubt if that'll happen because Congress is going to have to do something with Social Security to make sure it's there for us. So they're going to either raise the rates that you can take Social Security or we'll have to be taxed more, put more money into the system. There's never been the lockbox that they're talking about. The lockbox has never been there.
It's always been a lie, yeah.
It's been a lie. It's a pay-as-you-go system. So us baby boomers, there's 10,000 of us a day reaching 65. 76 million of us that are going to be retiring, getting Social Security. The generation before us, Generation X, there's not as many of them. So they're going to have to pay for more people in retirement. We're living longer, so that's going to be a problem with Social Security. The third leg is savings. Well, savings, you know, you go to the bank, you buy a CD. If you look at the paper, the rates on your CDs are anywhere from 0.05 for the big banks, 0.05, to some of the credit unions are paying 3/4 of 1%. Well, that's less than 1%. So there's not much in savings either. So that's a big problem for people going forward.
Okay. Well, that's cheery.
Yeah, well, we got to have some solutions to that, right?
Right.
We see the problem, and I'm the doctor of retirement, so we can make you well.
All right.
But first of all, you got to realize what the problem is.
Right, and I think that brings us to the next question about the red zone.
Oh, the red zone, yes. Well,
Kind of. I know we talked about this before the interview, but go ahead and just, for
Right.
people who don't know,
Sure.
tell them what the red zone is.
well, we know about football, our favorite sport, right? There's a red zone. When you reach the 20-yard line and you're heading for the goal line, you're about ready to make a touchdown, right? Well, the red zone in retirement is 5 years before retirement and 5 years after retirement. This is when you're getting ready to retire and soon after you're retired. Well, if you're in the stock market during those 10 years and the market goes down, then the chances of you running out of money in retirement are pretty high. And the reason is because if the market's down and you have to take money out of your retirement plan, that doesn't have a chance to go back up. So what are you going to do? Well, you're going to probably cut back on what you're spending, but if you have needs like housing and food and transportation, you can't really cut back on that much. You'll run out of money in retirement. So it's real important in the red zone to make sure that you keep your money safe, that you don't run out of money.
Okay. Now I know that Social Security, you can begin taking that at different times.
Right.
And you say it's really important as to when you take that.
Exactly.
You want to elaborate on that?
Well, when do you think most people take out the Social Security?
I would assume 65.
Oh, 62.
62.
Right.
Well, I know they can start at 62.
Right. And 65 is no longer the full retirement age. For us baby boomers, the ones born in 1946, is 66. And people born after that, it goes up gradually to 67 to reach full retirement age. But most people make the mistake of taking out the Social Security to age 62. Now, why is that a mistake? Well, first of all, people say they want to retire at a certain age, and they retire and they find out that, hey, I'm not making enough money, so I'm going to go back to work, right? Well, if you take it out at 62, there's a limit on how much you can make. It's around $15,000. After that, for every $2 you make over that, the Social Security takes $1 back. So you're limited on how much you can work. Number two, and most important, when you start taking out Social Security at 62, you're not getting the increases that you would have gotten if you waited till later. And the increases are 8% a year. 8% a year. Can you imagine? They're going to add 8% to your payment each year that you wait to your Social Security check. That's guaranteed. So where else are you going to get 8% guaranteed? No place I know of. So most people should wait at least until they're 66 and sometimes until they're 70 to take advantage of this increase that you're going to get if you wait because that's locked in. You're going to get that for the rest of your life. Another thing, the breadwinner should always, if there's a couple, the breadwinner should always wait at least till 66 or 67, whenever their full retirement age is, because they're actually getting money out for two people. They're getting it out for themselves and they're getting it out for their spouse. Because usually the guy's the breadwinner, right, the man, and the wife, the spouse, she can start taking out at 62 or whenever she wants to. But then, since the woman is usually younger and they live longer too, when the man dies, the spouse can take over his higher Social Security check.
Okay.
And that's some information we have about Social Security that a lot of people don't know about. They don't really think about it that much. And if they go to the Social Security office or if they call a Social Security and ask them these kind of questions, you know, when should I take it out, they can't really give you advice. They're not allowed to do that by law. So
They probably don't know anyway.
you probably get several different answers, exactly.
That's right. Okay. All right. So how do you get on one of the stool legs with savings?
Yes.
So how do you know how to make Social Security count?
Yeah.
Wait.
Right.
How do you make savings count?
Well, that savings is a short leg, isn't it? I mean, it kind of makes an unstable stool.
Well, it's not as short as the pensions.
Right, that's true. That's
Which aren't
really
there
short.
at all.
It's non-existent. So.
Yeah, I think we're falling over right now.
Right. Well, let's prop up that stool a little bit. Well, how are you going to do the savings? Well, you could put your money in the stock market. Well, if you got in the market back in March 2000, for the next 13 years, you didn't make any money. It was even. Well, you did actually make 2.1%. Well, that's just dividends. Well, if you're making 2.1%, it's taxed, right? So that's going to take some of the money away. And on top of that, you've got inflation, 2 or 3%. So by the time inflation and taxes are hit, your stock market gains, there are no gains, but what you made from dividends, you're in the negative territory. You're not making money. How about banks? Well, you go to bank, buy a CD. Like we said a while ago, you're going to get 0.05 or 0.75. That money is going to be taxed every year, whether you use it or not. And so you're going to pay taxes on that money, plus inflation's eating that up. So again, you're in negative territory. What the insurance companies have done, and insurance companies, they know how to make money. They will, you can put some money with them, either a lump sum or you can put monthly payments, however you want to do it. And you can purchase an annuity is what they call it. It's got a bad rap lately from some people, but what it does is fantastic, because with an annuity, you can have a lifetime income for one thing. But the main thing about annuities is they make more money than the CDs do, because the insurance companies, they invest in long-term bonds, investment-grade bonds, and so they're able to make a higher rate. And what they do is they will take a little bit off for expenses, less than 1%, a percentage of that, and then they give the rest of it to the client. And they can use that as they need, monthly, or they can let it accumulate tax-deferred. And then there's another type of annuity that goes up with the market but doesn't go down. So there's ways to make money even more.
Is that a fixed annuity?
Well, there's a fixed annuity. This is what I started out with in 2000. Actually, they started a new way to credit the annuities. Instead of just giving you a fixed amount, the insurance companies realized that there's not going to be much interest made out there in the future. Interest rates were going to go down. Well, how can we give our clients more interest? Well, what they did is they came up with a way to do that by linking it to the upside of the stock market. And instead of actually buying stocks, they will buy a call option on an index like Standard & Poor's 500 index. That's the top 500 stocks in the country. So what they did is they bought this option on the index. In other words, they put a stake in the ground on the day they issue your annuity, and then they put another stake in the ground a year later. And the market's gone up, they'll take some of the gain. If the market's gone down, then the option will just expire worthless. So there's no harm, no foul. Now the thing about the annuity is they don't give you 100% of the market, because when they go to the broker with millions of dollars every day and say, I want to buy an option, and an option is a right but not an obligation to buy this index a year from now, the broker says, well, we can't give you 100% of the market because you don't have enough money. Well, they're buying bonds, they're making pretty good interest, but not that great. So the upside is limited, but the other thing is there's no downside risk. So you're giving up some of the gains, but then there's no downside. And the guy named Jack Bogle that started Vanguard Group, he invented mutual funds. He said there's a reversion to the mean. And what he means by that is when the market's up, it's going to go down. And when it's down, it's going to go up. So the mean is halfway between the up and the down. So back in 2000, the market was up, right? It went down 2001, 2002. Then it went back up again in 2008 and went down again. We lost about 51% of the money in the S&P 500. And that's back up again. So the mean is halfway between the up and the down. So the market's up now. What's going to happen? Well, it's going to eventually go down. Nobody knows when, though. That's the problem. So if you can lock in your gains each year and not have any losses, that way you can make 2, 3, 4% more in the fixed index annuity than you can just a regular fixed annuity. They're both fixed annuities, but the fixed index annuity uses a different crediting method. They
and
use
you
the
can put as
market.
much in that as you want?
Right, you can put $1 million if you want to.
Okay, well, when I get that, I'll let you know.
Okay, give me a call.
Hopefully next year.
All right, fine.
All right. So, so here's one. How can I leave a legacy for my children and grandchildren? And I guess that would be annuities again you could do?
Well, annuities are one way, and also life insurance. Life insurance is a multiplier. For pennies, you can get dollars. And of course, you got to qualify for the life insurance. Annuities also, you can leave your children or grandchildren. You can split it, some for your children, some for your grandchildren, as a beneficiaries, because rarely do people pay out all their annuity. They have it for an emergency. If they need it, they can take it out 10% a year. There's a limit on how much you can take out every year, because the insurance companies need to have that for these long-term bonds so that they can be able to make this kind of interest. So there's ways to leave a legacy for your children and your grandchildren. You can say, I want a check for my grandchild on her birthday. And then the insurance company will pay her a check as long as she lives on her birthday for annuity payment. Another way is inherited IRAs. A lot of people will die and they leave their IRA to the heirs or their spouse. Well, if you do that, taxes are due right away. So with an inherited IRA, the insurance companies will let you inherit an IRA from someone else, or your loved ones, your husband or your father or mother, and that way you can stretch it out. It's called a stretch IRA for generations, actually. Different ways to do that, different strokes for different folks.
Too many lanes.
Well, what
so
we
I can
do,
see where
you're right about that.
Where we need someone like you that understands
Exactly.
the choices.
Exactly.
So you can narrow it down to the few that are
That's right.
appropriate for the individual based on
Exactly.
their situation, because everybody's situation is different.
That's right. And what we do is we listen to the client to see what they want, what they've got, and we ask them two questions. What do you want to do with your money, and what do you want your money to do for you? So we listen to them and find out those questions, find out how their assets are structured, and help them design a plan that they will not run out of money in the future.
All right. Now, besides all the risks we've talked about, are there other risks?
Oh, sure. One of the risks is long-term care. And I don't know if you have a long-term care plan in place. You might think you don't, but you do. You either have long-term care insurance, or you have another long-term care plan that if you need custodial care, if you need home health care, going to a nursing home, long-term care, you can spend all your money and then spend down to be in poverty with $2,000, and then Medicaid would kick in. I like to have my long-term.
That's not the best choice.
That's not a good choice. But you know, by default, about 70% of the people have that. A matter of fact, it's not if you'll go in a nursing home or need long-term care, home health care. It's when, because 70% of people will need long-term care of some sort during their lifetime. The type of long-term care I like is when I get to choose what type of care I get, where I want it, instead of the government deciding what nurse I've got. I want to choose my own nurse. I want to be able to retire in my home and not have to move to a facility. So you got to plan that too.
Okay. And is that something you deal with?
Absolutely, yes.
Okay.
That's one of the risks that we take care of.
All right. Now, I know that you're, I was going to ask you, are you a member of the Better Business Bureau?
Sure.
But I know you are.
Right. I've
Right.
been a member since 2004, April 2004, with an A+ rating.
A+ rating. Okay. Well, that's important. Is there anything that I haven't covered that you wanted to mention?
Well, just one thing, probably one of the most important things is we got to have a lifetime income we can never outlive. What you should do when you're planning for retirement is have a budget. See how much you're going to need for retirement. Housing, transportation, food, health care, all your expenses you're going to have. Figure in your pensions, if you have one, Social Security, and then there's probably going to be a deficit. The problem is that deficit, you got to fill that deficit so you don't have to worry about having to pay for those expenses from stocks or savings or that type of thing. So annuities fit this bill perfectly, because what happens, you can have an income annuity that will pay you a lifetime income you can never outlive. There's several kinds of annuities. There's a deferred annuity, like the ones we're talking about with the fixed index annuities. There's also a single premium immediate annuity where you start getting a check immediately. Now, the thing about insurance companies, they don't know when I'm going to die. I don't know when I'm going to die. But when you've got 100 people in the pool, they know when one of those people are going to die because of the mortality tables. So what they are doing is giving you mortality credits. That's the way they're able to give you a lifetime income. So if you've got somebody that's going to die in a few years, they're not taking much money out, but that money is going for the people that are going to live longer, and they can get a lifetime income they could never outlive. Now, some people don't like that scenario because they're saying, well, you don't want to leave something for my grandchildren or my children or whatever. Well, you know, you can leave them the house or savings or stocks or something like that. This money is for your retirement. Mm-hmm. But if you absolutely say, well, I don't really want to do that, I want to make sure there's something left over, there's something called a guaranteed period. So let's say I was going to retire in 4 years. I'm never going to retire, but let's say I slow down a little bit and I'm going to start tapping into my annuity. I could get a lifetime with 10 years. Let's say I start taking it out and 2 years later I pass away. Well, that's not too good, is it? I only took it out for 2 years. But then my wife, Susan, would get paid for the next 8 years. So I got paid for 2 years. She got paid for 8 years. Total of 10 years, somebody's going to get that money out. But I don't like that scenario too much. Right. So let's try another one. Lifetime, 10-year period certain. Let's say I start taking it out, instead of living 2 years, I live 22 years. I like that better. So it's going to pay me either 10 years or lifetime, whichever's longer. So my beneficiaries get it if I die soon. but it'll get paid out to me as long as I live. Now, that's one way to do it. Another way is there's these lifetime guaranteed income riders that you can get on a deferred annuity. And by the way, there's the fixed annuities and the variable annuities. I specialize in the fixed annuities because the variable annuities are in the stock market, and there's a lot of fees and expenses on those. And the only time you're going to have a fee with a fixed or fixed index annuity is when you purchase a rider. So what the rider does is it grows, and usually there's a bonus for these products too, by the way. The rider grows a certain amount guaranteed every year, and then when you get ready to turn it on, you tell the insurance company, I want to start getting this payout for a lifetime. Well, the difference in this, where you annuitize the annuity, in other words, start getting it paid out over a lifetime, like I said a while ago, you can't change that. Once you set that up, it's done. But what if you win the lottery, you get a big inheritance or something like that? You don't really.
That's my plan.
Why not? That's a lot of people have that plan. You don't really need that annuity payment. You know, let's cut it off. Well, you can't if you annuitize it. In other words, get it paid out. But if you get the rider, the guaranteed lifetime income rider, you can start and stop that whenever you want to. So there's a lot of flexibility about that. So there's all kinds of ways to make sure you have a comfortable, safe, guaranteed retirement. And that's what we're able to do. But we listen to the clients, see what they need, what their resources are, and guide them down the right path, because there are a lot of options that are open to you.
Well, you certainly sound knowledgeable about it, and you sound passionate.
Oh, yes. That's what I've been doing for quite a few years now, and I'm able to help quite a few people out. And I really enjoy it. It's a lot of fun.
Well, you sure seem to. So if you are in the situation, well, all of us in a situation where we have to start thinking about retirement at one point or another, and if you are in that red zone, or you're approaching it, or you're just thinking about it and you say, you know what, if I start now, I don't have to put in so much at a time, then you might give Jim a call at Guaranteed Retirement Solutions. His contact information is at the end of this video, and it's also at the bottom of this page. And I'm sure he would be glad to help you out. There's a lot of roads you can take, and he can help you navigate to the right solution for you.
Exactly.
All right. Well, thank you very much for coming in
Thank you,
today,
Roy.
and I wish you a great deal of continued success.
Thanks a lot. I appreciate it. Thank you.